Hello and welcome to The Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. I'm Chris Termack, stepping in for Tom Edwards this week, and today we are asking the question, what makes a reserve currency? Reserve currencies represent international safe stores of value, both for central banks and private companies and individuals. Money is held in reserve in case it is needed, a rainy day fund with investment returns a secondary consideration. Because reserve currencies are primarily about where money is stored, being a reserve currency lowers borrowing costs for the issuing country. Now, the US dollar has been the dominant but not only reserve currency since 1947. In recent years, its role has been eroded as other currencies have gained market share. There are 5 key characteristics that confer reserve currency status. A currency does not have to be perfect, it just needs to be better than the alternatives. And on some of these criteria, the US dollar's advantage does seem likely to erode further, but its reserve status will not disappear entirely. Well, let's unpack the topic with our friend and regular Paul Donovan. Paul's the chief economist in UBS Global Wealth Management. Paul, always a pleasure to have you on the show, and we're going to start with a basic question here. What is a reserve currency?
Well, it's a good question because it's often misunderstood. A reserve currency is where you store money almost as a sort of a rainy day fund, just in case of emergencies. It's not necessarily the currency you use for international transactions. So you and I might agree to buy and sell something using, euros or Swiss francs or pound sterling. And that would be just the transaction currency, generally known as the invoicing currency. But at the end of the day, if you thought, right, I want to keep some of this money safe and secure just in case I need to use it in the future, where do I park it? And if you decide to store that money in dollars, then the dollar would be the reserve currency that you are using. So the reserve currency is essentially, it's a safe haven where you can store money in case of need.
We will get to the impact of some of those international transactions in a moment, but when you also bring in the dollar there, tell us about sort of the criteria then for a safe haven. What turns a currency into a reserve currency?
Well, there are a variety of characteristics which have got different levels of importance when we're talking about a reserve currency status. One of the ones which tends to get a lot of attention is liquidity, because the whole thing is that you need to get your money out quickly if there's an emergency. If you need to dip into your reserve, you want to know that the money is going to be accessible. So that means that you need to have a large liquid bond market or similar asset market, ready availability of getting cash. That also means that you need access. So capital controls and reserve currency status don't really work very well. If the ability to pull money out is restricted, that's generally not a great thing to be having overall. You need stability. If you've got hyperinflation, if the value of the currency is in free fall, that's not really going to work. If you've got a history of defaulting as a country, again, that's not going to really work because you want your money to be safe. And obviously, if there's a chance that the government's not going to pay up on its debt and not going to redeem its bonds, that's not going to make it a reserve currency. So somewhere like Argentina, which has a long history of defaults, very unlikely to be a reserve currency provider. A degree of geopolitical influence up to a point has relevance because if you are a reserve currency backed by geopolitical influence, other countries want to be your friend. They might then choose your currency as a safe store of value. They might also be buying defense equipment from you. And so you're saying, well, if I'm going to be buying in dollars in the future to buy armaments, I might as well keep my money in dollars today so that money is readily available when I need it in the future. It's not absolutely essential. I mean, Switzerland is a reserve currency. The Swiss franc is a reserve currency, and Switzerland's geopolitical influence is not the same as that of the United States or indeed of the UK or the Euro area. So, it's not 100% the same, but that's also going to be an issue. And then the final one, which I think is a big one, is rule of law. That is to say, if you own something, you want to be pretty secure that no one's going to take it away from you arbitrarily. You want to know that if you're storing money in an asset in that country, you can go to the courts and force the asset to give you the money back in time. You don't want to be in a situation where the government can say, no, that used to be yours, it's ours now. That's not going to be ideal for a reserve currency. So rule of law is the key thing. But ultimately, what all of these things add up to is a confidence that you can get your money back when you need it, because that's the whole purpose of a rainy day fund.
And when it comes to that confidence, you were kind of going through the abstract criteria there, but obviously the US dollar is the one that has had that confidence from investors and from countries over the last, well over half a century at this point, dominant since World War II, taking the place of the sterling after a little bit of a period of sort of questionable few years of which reserve currency would establish itself. But tell us about perhaps that moment to explain this criteria as well. How did the US dollar manage to establish its status as a reserve currency?
Well, it's important to recognize that the dollar is certainly the dominant reserve currency, but it isn't the only reserve currency. The euro, the pound sterling are reserve currencies, as is the Swiss franc, the Canadian dollar, the Japanese yen, and the Australian dollar all have limited reserve roles as well. But what happened in the 1920s and the 1930s is that the UK had been on the gold standard, so the value of sterling had been tied to the gold standard, and then in the early 1930s it came off of the gold standard, so the value of sterling suddenly became more unpredictable. The United States stayed on the gold standard. It wasn't necessarily the greatest idea, but its value was more predictable for a longer period of time until it too eventually became less secure and moved off the gold standard. But during that interval, it had sort of established itself as being a slightly better store of value, perhaps, than the pound sterling, which had been moving around in the foreign exchange markets. US financial markets at that time were becoming more important. The US economy was growing its importance in the global economy, and with that, the financial markets. And even after the 1929 equity market crash in the United States, the US financial market still had a reasonable degree of liquidity. The bond market was growing in size. The geopolitical position of the United States was still very weak, so that wasn't a particular issue in the 1930s. But obviously, during the Second World War, the geopolitical position of the United States changed very dramatically. And after the war, in 1947, when the dollar became the central role in the global financial system and became the dominant reserve currency, what we saw leading up to that was the UK going down the route of capital controls. There was a big devaluation of sterling in 1947. So again, that stability of value was being undermined. Liquidity was still there. Rule of law was still there. Those were not being undermined. But on these other criteria, the dollar started to look more attractive. Sterling remained a very sizable reserve currency. It was known as the sterling area for a very, very long time after that, really up until the 1970s, when the reserve status of sterling diminished even further. But there was still that clear dominance of the dollar from 1947 onwards.
Now, Paul, as you say, the US dollar is the main reserve currency. There are other reserve currencies, but it does dominate. And perhaps you could describe to us how the US has benefited from that status over the last many decades. And conversely, I suppose, related to that, how much of an impact would there be if that status was suddenly taken away?
Well, in terms of the benefit, essentially, if you are a reserve currency, people are willing to lend you money at a lower cost than would otherwise be the case, because people are saying, well, actually, we need to store our money somewhere. We want to store it in dollars. So that increases the supply of dollar cash that is then available for investment, and allows an economy like the United States to invest more cheaply in domestic productive capacity, which is generally considered to be a good thing. So for any given exchange rate, for any given level of the dollar in the foreign exchange markets, the cost of borrowing in the United States is lower by reason of it being a global reserve currency. So That's the key issue. Now, if it was taken away very suddenly, that would be very disruptive because established financial system links would be undermined and the cost of borrowing would go up very abruptly in the United States. I have to say an abrupt end to reserve status is unlikely. And even when the UK sort of gave up its dominant position in 1947, as I said, it remained a reserve currency and a significant reserve currency, and indeed is a reserve currency to this day. So I think an abrupt loss of reserve status is quite unlikely, and a more gradual decline in reserve status would mean sort of a slow grind higher in the cost of borrowing in the United States over time, less disruptive, but it still does mean that the advantage of being able to cheaply invest fades for the United States over a number of years.
And Paul, that does bring us somewhat to the present day, because for years now we have been talking about sort of multipolar world, politically speaking, economically speaking. But when it comes to reserve currencies, it's been more of a slow trickle, hasn't it been? The dollar has still been holding.
The dollar has held. It has been eroded. I think that's fair to say, because both central bank holdings of dollars and the private sector's willingness to hold dollars has retreated in recent years. Central bank holdings of dollars have diversified. So the euro has been something of a beneficiary, but actually it's the other currencies, sterling, yen, the Australian and Canadian dollar, and to some extent the Swiss franc, that have been receiving a little bit more of the inflows as central banks have looked for more diversified portfolios. In terms of the private sector, that's harder to judge because the private sector's investments are a lot more complex, and discerning what is reserve investment versus non-reserve investment is a little bit more difficult. But I think there has been some move away from the willingness of the private sector to focus on the dollar as a reserve currency. More trade is being done in non-dollar terms in recent years. Europe, for example, if it's exporting, will tend to invoice in euros and so on and so forth. So that has sort of chipped away at the dollar's status so far.
And Paul, the fact that there's been a chipping away, but at the same time the dollar being the dominant currency even in this moment, is that down to the dollar still having a sort of underlying strength to it, or is there also just a lack of trust in the alternatives, including, say, the euro, which has probably risen more than any other currency in its status?
Well, I don't think it's necessarily a lack of trust, but if we go back over those criteria, what makes you the dominant reserve currency? You don't actually have to be perfect. You've just got to be better than the next alternative. And so, for example, particularly with liquidity, there is a single US Treasury market, which is a very, very liquid, very, very sizable government bond market. There isn't the equivalent in Europe. You've got lots of national government bond markets, but you don't have the equivalent liquidity and scale of the US Treasury market. And that's been an issue. For example, a few years ago, the Swiss National Bank, which holds quite a lot of their foreign exchange reserves in euros for fairly obvious reasons given their geography, they suddenly found themselves owning an extraordinarily large percentage of the 2-year German government bond market because they were saying, well, we need to invest in government bonds and safe assets as part of our reserve. We want to put them in Germany because there isn't a European alternative. And they ended up actually having what was considered too large an allocation to the German government bond market. So that liquidity story has worked to the dollar's advantage relative to, say, the euro. But other factors have perhaps not been as advantageous, as big a benefit comparatively over time. That's perhaps why we've seen this erosion and why we may continue to see the dollar's position as a reserve being weakened in a relative sense over the coming years.
Now, I wanted to get to a few things, Paul, that might, I suppose, speed up that erosion in the current environment, because there are some concerns that you write about. We have to start with trade, because even if, as you said at the outset, international transactions are not what reserve currencies are about, how companies trade, what reserve currency they then go to after a trade, that does matter. So in that sense, too, what sort of impact would slowing trade globally and with the US, more protectionism and tariffs that we're seeing at the moment, what kind of impact would that have? Could it lead to less importance for the US reserve currency?
Well, I think it leads to two things. Firstly, it means that reserve currencies themselves become less important. So if you are doing fewer international transactions, you will hold less money in reserve just in case, whether as a central bank or as a private company. And so if the volume of trade starts to decline, or if trade to GDP starts to decline, the necessity of holding so much money in reserve in a foreign currency is going to fade. And so the correlation of the trade to GDP ratio to the reserve currency to GDP ratio is quite high. If, therefore, we see less trade as a result of the United States sort of disengaging with the rest of the world, that is going to be something which reduces the desire to hold any currency in reserve, dollar or otherwise. In terms of what is happening around US trade at the moment, the rise of economic nationalism, there has been an increase, for example, in anti-American sentiment and things like that. That may also lead to people saying, well, the geopolitical environment in which we find ourselves, maybe there are more risks to us holding money in dollars specifically. Maybe we want to look elsewhere. Maybe some of those other criteria are not flattering the dollar quite so much, and we need to rethink. So in that sense, you may then see not just less money being held in reserves overall, but the percentage of reserves that are allocated to dollars continuing to decline as a result of the trade upheaval.
And just to follow up on that, there's one aspect, as you mentioned there, through trade and sort of the US pulling out, where countries could decide through anti-Americanism, if you will, to sort of pull back from the US. But there could also be an active decision here, couldn't there, through a trade dispute kicking in a country, say, threatening or even deciding to withdraw capital from the US. What are the chances of that?
That is always possible, because to do so would be very disruptive to the United States and would have economic costs. I actually think that this is a relatively unlikely option in the sense of pulling money out and actually following through with it. It would be taken as a very, very hostile act, and the disruption to US financial markets would be significant. It would create what economists call disorderly financial markets, in which case the Federal Reserve would probably have to step in. So that would sort of offset some of the bargaining power or leverage that selling everything would have. A more likely scenario, perhaps, is that foreign central banks simply stop buying. So they don't show up to bond auctions. And remember, foreign central banks are important holders, US Treasury bonds. That's where they store their reserve currency. So if they now say, actually, you know what, we're not going to hold so much in US Treasury bonds, so we're just going to, this bond matures, we're going to take the money, thank you very much, we're not going to reinvest it in the United States. What that means is you're losing an important buyer of bonds. That starts to push up the interest rate, may potentially also weaken the dollar as well. And that would do economic damage without sort of the economic nuclear option of saying, right, we're going to sell everything all at one go. So that, I think, is a more plausible scenario, that failing to show up at bond auctions and gradually disinvesting is something that we might see in response to the current trade tensions.
Paul Donovan, thank you very much for joining us. And that brings us to the end of this edition of The Bulletin with UBS, setting the agenda in the fast-moving world of finance every week here on Monocle Radio. Listen again and explore more at monocle.com. That is where you can join the club by subscribing to Monocle Magazine. You can also follow this program wherever you get your podcasts. And don't forget to discover more and to find out how UBS can help you at ubs.com. This is The Bulletin with UBS on Monocle Radio. I'm Chris Chermak. Thanks for listening.